Hi there, I'm Brad Pierce, realtor and co-owner of the Pierce Group brokered by eXp Realty, based right here in Omaha, Nebraska. Today we're going to be talking about something that a lot of Omaha homeowners overlook when selling their home: taxes. Now, we're not just going to talk about income taxes. In this video we'll cover capital gains, prorated property taxes, and more things to consider when selling your home. If you're planning to sell in Douglas or Sarpy County in Nebraska, you'll want to watch this all the way through to avoid costly surprises at closing. Please note, the information in this video applies only to single-family residential real estate. Investment and rental properties, or properties you may have inherited, have a different set of rules when calculating capital gains and property tax liabilities. We plan to cover these in a future video. Also, this video should be used for informational purposes only. Always consult with a trusted accountant, tax advisor, or attorney before making major real estate decisions. Now, let's start with discussing capital gains. A capital gain is a profit you make from selling an asset, such as real estate, for more than you originally paid for it. Capital gains are subject to capital gains tax, which is a levy on the profit you make from the sale of your asset. The formula for calculating capital gains is your net sale price minus your adjusted cost basis. Now, capital gains from the sale of real estate can be excluded from tax liability, but they must pass the federal ownership test and use test. For the ownership test, you must have owned the home for at least 2 of the past 5 years. In the use test, you must have lived and used the home as your primary residence for 24 months over the previous 5 years. Now, these 24 months of residency do not need to be consecutive. When selling your home and you meet these 2 requirements, you can exclude up to the following amount in capital gains from your personal tax liability. Single individuals can exclude up to $250,000 in profit, and married individuals filing jointly can exclude up to $500,000. Note, there are a few IRS exemptions for what they call unforeseen circumstances, such as job loss, divorce, and medical emergencies. If you're selling your home and you've lived there for less than 2 years, or don't meet the other occupancy requirements for the federal capital gain exemption, be sure to consult with your tax accountant, tax advisor, or attorney. Now, going back to the formula of capital gains equals the net sale price minus the adjusted cost basis. Let's talk about what your net sale price is. That is your gross sale price, so what you actually sell your home for, minus your selling costs. Selling costs can include several different items. Some common ones include realtor commissions, title and transfer fees, and inspection fees. Now, what is an adjusted cost basis? This is the original purchase price for which you purchased the home that you're selling, plus the original closing costs, plus any capital improvements you've made. So, what are capital improvements? They are permanent, non-routine changes to a property that add value, such as building a deck, extend the home's usable life, such as replacing the roof, or adapt to new uses, such as finishing the basement. Now, to make sure this makes sense, we're going to go through an example. Let's say that you sold your property for $400,000, which is the gross sales price, in 2025. You had a total selling cost of $25,000. That includes things such as realtor fees, title transfer fees, and inspection fees. So our net sale price is $400,000 minus $25,000 to give us a total net sale price of $375,000. Now let's calculate the adjusted cost basis. Let's say in this example you purchased the home you're selling for $300,000 in 2020, which is your original purchase price. And you had $5,000 in closing costs, and you made $20,000 in capital improvements. Let's say you remodeled your kitchen. So our adjusted cost basis will be $300,000, which is your original purchase price, plus the $5,000 in closing costs, plus the $20,000 in capital improvements, which gets us to $325,000. Now, let's calculate your capital gain. So we're going to take your net sale price, which is $375,000, minus the adjusted cost basis, which is $325,000, and get a capital gain of $50,000. Pretty good for 5 years, right? Now, let's look at exclusion eligibility. For this example, we're going to assume that you lived in the home for at least 24 months as your primary residence in the last 5 years. So your $50,000 capital gain is less than the $250,000 cap for single individuals and less than the $500,000 cap for married couples. So good news, you have no capital gain tax liability. So let's talk about some key takeaways about capital gains. You should always try to occupy your home as your primary residence for at least 24 months over the past 5 years. If not, and you experience a capital gain from the sale, work with your tax advisor to explore potential unforeseen circumstances exemptions to avoid paying capital gains tax. If you experience a capital loss after selling your home, work with your tax advisor to apply this loss to reduce your overall income tax liability. Also, be sure to maintain accurate records and receipts of all closing costs, selling costs, and capital improvement expenses. Make sure you receive an IRS Form 1099-S after the sale. Now, if you look back at our formula, it's important to keep receipts, especially for your adjusted cost basis. Having a higher adjusted cost basis will decrease the amount of your capital gain. So detailed receipts of your capital improvements and closing costs from your original sale are really important. Also note that any capital gain exceeding $250,000 for single individuals or $500,000 for married couples, or any realized capital gain not meeting the federal tax exclusion criteria are subject to both federal and state capital gains taxes. Alright, now let's talk about property taxes. In Douglas and Sarpy County, property taxes are paid in arrears. This means that owners pay the previous year's taxes, so 2024, in the current year, in 2025. It's not entirely clear why we pay taxes in arrears. However, it is a practice that began during the Great Depression as a way to help property owners delay their tax payments, leading to our current catch-up tax system. Taxes owed from the first half of the previous year, which would be January 1st through June 30th of 2024, are due to be paid to the county by March 31st of the next year, 2025. Taxes owed from the second half of the previous year, which would be July 1 through December 31st, 2024, are due to be paid by July 31st of the next year, 2025. Here's where things can get a little bit confusing. When you sell your home, the property taxes from the previous year, in our example 2024, are prorated between the buyer and seller based off the closing date in the current year. Depending on your closing date, you may have already paid all, some, or none of your taxes owed from the previous year, 2024. The date of close and amount of taxes you've already paid determines whether you will owe the buyer some money for taxes at closing or if they will owe you. So yes, it is strange. The buyers of your home are liable to pay a portion of your 2024 property taxes even though they never owned or occupied the property during that time. Weird, right? Now, the title company and lender, if you have a mortgage and escrow account, will work together to balance these exact closing figures for you. Also, if you have a surplus in your escrow account for property taxes, those funds will be returned to you after closing. Now, we're going to look at two different examples to illustrate the difference in the closing date to see what impacts that have on your prorated taxes. For our first example, let's say you sell and close your home on July 10th of 2025. If I'm counting right, that means you owned your home for 191 days in 2025. Let's assume that your home was assessed for a property tax liability of $6,000 in 2024. $3,000 of that was due March 31st of 2025, which you paid through your mortgage escrow account. The remaining $3,000 is due on July 31st, 2025. So some quick math. We'll take our $6,000 property tax liability divided by 365 for 365 days in the year, which gives us about $16.43 due in taxes per day. We'll take that daily tax amount times 191, which is the amount of days you occupied the property in 2025, to get us a total of $3,138.13. Now we're going to subtract the $3,000 that you already paid through your escrow account to come to a total of $138.13. In this example, at closing, you would owe the buyer $138.13 for property taxes. This will be deducted or debited from your sale proceeds. Essentially, you're paying the buyer for your share of unpaid taxes minus the amount you've already paid for. Hope that makes sense. Now, example 2 is using a different closing date. Instead, let's say you sold and closed on your home on August 15th, 2025. That means you own the home for 227 days in 2025. You paid the first half of your 2024 taxes on March 31st, 2025, and the second half on July 31st, 2025 through your mortgage escrow account. So, breaking down the tax rate by day is the same from the earlier example, but we're going to multiply that by 227 days because that's how many days you occupied the property to get a total of $3,729.61. Now we're going to subtract $6,000 from that figure since you've already paid $6,000 in taxes for 2024, which equals negative $2,270.39. So this example, at closing, the buyer would actually owe you $2,270 for taxes. This would be added or credited towards your sale proceeds. Essentially, the buyer is reimbursing you for their share of taxes that you've already paid. So some quick key takeaways about property taxes when selling your home. If you sell before July 31st, be prepared to possibly owe the buyers for unpaid property taxes. If you sell your home after July 31st, you'll likely receive some money from the buyers at closing for taxes that you overpaid. Be sure that you monitor your mortgage escrow account to ensure that the bank is paying your property taxes on time. Or if you own your home outright, meaning you bought it in cash or you've already paid off the principal of the loan, make sure that you're independently making timely payments to the county. They will charge you interest on a daily basis for delinquent taxes. And lastly, remember that the title company and lender, if applicable, are responsible for balancing closing figures, including tax prorations. Well, let's wrap this thing up. I hope you found this information useful in understanding the tax implications of selling your home in Omaha, Nebraska. Got a question about selling your home? Drop it in the comments below or send me a direct message. I answer every single one. And don't forget to like, subscribe, and share this video with someone who might be selling soon. Again, my name's Brad Pierce. I'm a licensed realtor and co-owner of the Pierce Group brokered in eXp here in Omaha, Nebraska. My wife Sarah and I have helped hundreds of Omaha homeowners like you sell their homes. We would love to meet you and learn more about your personal real estate goals. Please consider reaching out. Our contact info is below in the video description. As always, thanks for watching, and we'll see you at the next one.